Check, 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 check. Someone give me a volume check. Let me know. Okay. All right. You may or may not hear my kitty cat, otherwise known as training cat. Sometimes she's called trading cat. Just depends on what I'm doing. But she's decided the last week or so to stir up old habits. It's like she had a fall and hit her head or something. But she's demanding to be up on my desk, and she has a very good knack for making things go wrong on my keyboard when she throws her body down on it. So, how's everybody doing? Each week, scaring more and more away. Soon enough, you'll be able to chat and it won't even scroll anymore. It's okay. Ooh, first timer. Okay, Scott, welcome. Just hang in there. Don't get lost tonight. Another first timer. All right. Welcome, welcome. We go at a pretty good pace in here. So, for you guys that are first timers, do me a favor. Say first and give me a dash and then tell me how long you've been in IML. So, for you guys that are first timers here tonight, give me a first with a dash and then tell me how long you've been in IML. There you go. Persist until success happens. That's pushing it. 1 week. Oh, okay. Well, welcome. Any other first timers here? All right. Don't be bashful. It's not like we know who you are through your username anyway. All right. So I'm going to put up an information screen, and I'd like you to take a screenshot of it, and maybe some of our group coaches and admins will um, explain it and or give you additional information later on. So let me get that up first so we can move into tonight's material, which is the right time to present it because you newer folks are going to want to know why we're doing what we're doing in here. And you guys that have been around, you know me, it's going to be a math lesson tonight. It's going to be a math lesson. So there's a screen. If you're brand new, take a screenshot of that the best you can. Hopefully it comes out clear enough. And some of our groups helpers will help you. Good evening, good evening. So we do have a Facebook group that ties hand in hand with what we do in here. I believe in interactive coaching. So you have a chance to see what we do in here and learn and then put it to practice on your charts and then post those charts in our group and we'll help you. So above and beyond this class, you get to get coached. And not another math lesson. No, this is the big math lesson. Hey guys, I'm not going to candy coat anything. No sugar coating in here. I tell it the way it is. And if that scares you away and gets you running with your tail between your legs, I'm sorry. It's just the math is real with the Forex. And you can't escape it. And so if you're going to be a Forex trader, you have to be able to do the simple math. Think about the simple math. You can't avoid it. And part of the reason you don't hear this told very often, there's Theo saying no one else will teach you this math. That's because, for the most part, the rest of the world is in the old paradigm. So we talk in here about the new paradigm. And the new paradigm is this: low yield, low risk, high yield, low risk, high yield, and a mindset to go along with that. So the new paradigm is low risk, high yield, and we work with your mental and psychological growth, not against it. The old paradigm works against it. Low risk, high yield. And as we move forward as the Charlie Delta traders, you're going to know and realize that and experience that more and more every day, every week. All right, we're going to be talking numbers tonight. So I have to be true to the CFTC's intention. They are the people that regulate me as an American educator. So I do have to remain in compliance with that. And so I have a disclaimer that you need to make yourself familiar with. If you're watching this as a recorded session, you actually need to read this disclaimer before you proceed. Might be a little fuzzy. So essentially what it says is, you've seen this probably other places before. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. Past performance is not indicative of future results. The high degree of out leverage can work against you as well as for you. Before deciding to invest in foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with foreign exchange trading, and learn and seek advice from an independent financial advisor if you have any doubts. All information posted on this website or in this webinar, in this presentation, is our opinion, the opinion of our visitors, and may not reflect the truth. Not that we're going to intentionally mislead you, but have to warn you. Please use your own good judgment and seek advice from a qualified consultant before believing and accepting any information posted on this website or presented tonight. Hypothetical performance results may have inherent limitations, some of which are described below. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. In fact, there are frequently sharp differences between hypothetical performance results and the actual results subsequently achieved by any particular trading program. Now, so you've been duly warned and informed, and we've got the disclaimer out there. So tonight, we're going to talk about how stop losses are not just for stopping the loss in a bad trade, in a trade gone wrong. Stop losses are the absolute profit regulator in a trade, bar none. So let's talk for a second about how all that works. And then I have a few questions for you. So let me see here how I'm going to do this. I got to bring up one other thing that I forgot to bring up. So let me see if I can find it. There we go. All right. I think I got what I need to pull this off. So, as a review for those of you who have been here, but for those that haven't been here before, I want to talk a little bit about how you deal with risk in a trade, and to let you know that deep down behind all the numbers that I do the same thing IML does in terms of risk, and that is we operate off of fixed percentage risk. So this looks a little bit like a busy slide, but let's walk through it real quick. For those that are reviewing, it's okay. You got to pound your subconscious. That's how your RAS gets adjusted. All right. So what we have here is this. Underneath the white background is the MT4 harmonic scanner from IML in white. And as you know, it paints the scan on the chart. It tells you which scan you're dealing with. It paints the scan on the chart. Depending on the scan, it gives you one line as an entry line. If it's a shark, it typically has two lines called a potential reversal zone. And the math is done for you for your position sizing. It says if you have a $5,000 account, and it's a standard account, which means a $100,000 contract, which means $10 a pip. If that's the case, and you want to put 2% risk into your trade, and you have a 79.7 stop loss, you can put 0.13 standard lots into this trade. And what that really means is if price backs up those 79.2 pips, or 79.7 pips, if it backs up there and it goes right beyond that, the trade station will take you out. You will indeed have lost 2% of your account. So all of that math is done for you. What's not done for you is, what if I don't have $5,000 in my account? What if I have something different? All right. So the amount of lots you're going to put in the trade is going to vary then. So what TradeCalc does, it's a little Excel spreadsheet, is it lets you enter the same raw information that is provided on the chart, and you need to learn how to do this. If you want to do it mathematically, here's the formula. It's your account balance times the risk percent divided by your stop loss times the value of a pip. And when we do that here, here's our $5,000. Who's our 2% risk? Here's our stop loss at 79.7, and there's the 10 for the value of a pip. And 1 over 797, it says we can put 0.125 lots in. It rounds up to 0.13. TradeCalc, I'll give you at the end of the, it was the first slide up, or the second slide up, that I said take a screenshot of, but we'll put it up at the end as well. And Tim or Zoe or Theo or Steven, somebody will type in the URL for you. So TradeCalc now will do that position sizing for us. And in the same example, we enter 10 for the value of a pip in a standard account. We enter our account balance. We say we want to risk 2%. We take the stop loss right off the chart, 79.7 pips. We go chick, 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 and hit a return, and it says we can put 0.13 lots in the trade. Same 0.13 lots in the trade that the MT4 scanner told us to put into the trade. So that is your validation that TradeCalc uses the exact same formula that Christopher Terry put inside the programming in the MT4 harmonic scanner. The challenge is lots of people love the web scanner, lots of people don't like MT4. And so when the web scanner comes up, you don't have all this information out for you. So here comes TradeCalc to your rescue. So you know how many lots to put into the trade. So you're not over risking. And all the information you have to pick off the chart, off your web scanner, is the size of the stop loss. You already know a standard account is $10. If you have a mini account, it's $1. If you have a micro account, it's 10 cents. In TradeCalc, all you have to do, you probably can't see it there, there's a little tiny red dot after it says value of 1 pip. If you put your mouse over that, it'll explain why it's 10 $10, $1, or 10 cents here. You put in your account balance, whatever it is. You put in how much risk in the trade. It better not be more than 2% right now. That's my recommendation. You can put in whatever you want. I'm an educator, not an investment advisor. And your stop loss, and you crunch that, and it'll tell you how many lots you could put into the trade. So the only purpose for this slide, and some of you are tired of seeing it now, is to show you that this formula is the formula for fixed risk position sizing. It's the formula used inside MT4 harmonic scanner, and we've just duplicated that part of it here in Trade Calc. Trade Calc does other things, but as a minimum it does position sizing for you. Alright, so let me ask you something. Let me go to black space for this. Let me bring up my blackboard. By acknowledgement of, well, let me do this. Let me do it this way. Let me bring up a scan. Clear the pitchfork off this one. So here we have the IML. If I could slide it over about 4 screens. Here we go. Here we have the IML scanner. Hang in there, guys. There's going to be some stuff you haven't seen before. It's going to blow you away. You're also going to be able to tell who's a real trader after this session. You can be able to tell who's a real trader. When I say real, they're not chasing rainbows and lottery ticket trades. They know what they're doing because of how they talk. So we have the IML harmonic scanner. Now let me ask a question. And for those of you that are familiar with the scanner, how many of you think that for the most part you could get in a typical trade entry here? Notice where there's 2 lines and a stop loss back here. How many of you think with this scan that you could have entered the trade somewhere in that zone? I mean, you know, part of your IML Platinum membership is to pay for the harmonic scanner. It also pays for your membership to view the IML Academy and to be. No, it's not a trick question. I'm trying to get down to simplicity. Is the scan hypothetical? Here's the stop loss way back here. All I'm asking is, for the most part, is it hypothetical or is it a fact that some traders will be able to enter that trade? Here's my 2 entry lines. Here's my stop loss way back here. Do you think you can enter and or be taught to enter that scan trade with your stop loss back there in that PRZ zone? I'm not asking for anything other than, can you enter that trade? Some of you are too worried about being too precise with the PRZ zone. The stop loss back here. The scan is not hypothetical. The scan is absolute math. You can't be more precise than the scan. It's 5 Fibonacci's laying on top of each other. The scan is not hypothetical. The scan is 100% math. The B is there because the absolute Fibonacci of that price move when it pulls back that far, yields a number that is part of a scan. And then it looks for the next numbers. The AB Fibonacci. And if that turns into a certain range, it could be part of a scan. And then the XAC and the XCD and the XBC, the XBD, the BCD. You can't get more precise than a scan. There's nothing hypothetical. It's all math. What I'm asking is, the hypothetical part or not is, can traders enter that on a routine basis with the stop loss there? I saw a trader who is, oh, y'all are going the wrong way with this. You're not, I'm not talking about where you would enter it. I'm not looking up for, your entry technique. I'm asking if you think you can be trained to do that. I'll give you an example. The trader in our overall group, some of you know, I'll just say his first name is Michael, and he's teaching his team a strategy and I saw a girl using his strategy today, talking about she's so glad she found the scanner and his strategy because she made 9 out of 9 trades this morning. So see, I know it's possible for traders to enter here and make successful trades. So we know we can trade. Now the difference is, where some of you were kind of jumping to early on, is the level of precision. But we'll talk about that later. The first thing I want to establish is, in a bigger picture, can we actually enter that trade? And the answer is going to be yeah. All right. And that's not hypothetical. See, the hypotheticalness of that question goes away when you see people doing it. It's no longer hypothetical. Now, a brand new person, you might have more to learn. You might have to understand Fibonacci. You might have to understand support and resistance. You might have to understand what a harmonic pattern really is. I'm not asking that. I'm asking the traders who know what it is, can you get in there? So now let's look at something. I want to bring up Trade Calc. Don't worry about what we got on the screen. All right, so Trade Calc. Here we go. Now, let's see how that comes across today. What kind of clarity we have on that. It's a little blurry. So let me see if I can blow it up one notch. Without it going off screen. It's the only thing I don't like about Wirecast is it's not very clear. Which means I'm going to have a little trouble with my presentation tonight, but that's okay. We'll work through it. Yeah, it's just because you're down under. Hey guys, let's not ask questions in here, please, to each other. That's distracting to everybody else that's here. Let's just save some. Oh, I know it's the streaming service. It's Wirecast, and it's how it's set up. All right, so I'm going to go for it because I can't make it much bigger than that. What we have in Trade Calc is these four fields here, as we talked about. The value of a pip, how much money I got in my trading account. I'm going to put 2% into this trade. Let's use the same 79.7, and it tells us we could put 0.13 lots into the trade. Now, what I want you to pay attention to is right here, and I'll put a white rectangle around it. Hopefully, it will prevail. And what that white rectangle says is for this trade, where I'm putting 0.13 lots in my trade with the 79.7% stop loss, where I'm putting 2% risk into the trade in my standard account, it is telling me that I can make $1.25 per pip gained. So it's giving us the calculations of profitability in this trade. If you can't read it, just trust me. What this says right down here is $1. Come on. Seriously? I think $1.25 per pip. Oh, hang on there. Don't leave me just yet. Wait until you see where we're going. And we won't be long tonight, so you'll get out of here in time to go study and draw pitchforks, etc. $1.25 per pip. When I have a standard account and I have $5,000 in my account and I have 2% to my trade and I have a 79.7% stop loss. 79.7 pips. So that was 79.7 pips in my stop loss. We can make, when I say can, we will make, if we enter that trade, $1.25 per pip. So now what we're going to do is say if I had a more precise way of entering this trade, and let's be very conservative in saying so. Instead of using a 79.7 stop loss, I'm going to use a 20 pip stop loss. Everything else stays the same, guys. Nothing else. We're talking about the same trade. It's still a standard account. I still have $5,000 in my account. Now I'm going to put my 2% risk into a 20 pip stop loss. And when I do that, I want you to watch the rectangle. It says I will make $5 a pip. In the very same trade. Now, what is not hypothetical here, or what is hypothetical in one sense, is fact in another. The hypothetical would be, does this trade go 100 pips? Does this trade go 150 pips? Does this trade go 200 pips? That's the hypothetical. Pick a number. It doesn't matter. If we say it goes 100 pips, then the trader with the 79.7 stop loss is going to make 100 times $1.25 a pip, or they're going to make $125 in that trade. And if the other trader had the exact same account, the exact same standard account, the exact same $5,000, the exact same 2% into their stop loss, they're going to make $5 a pip. And so if the trade went 100 pips, they made $500. Now I'm going to ask a simple question. Don't put too much thought into this. Don't read it. It's not a trick question. Would you rather make $125 on a trade or $500 on a trade? Yeah, me too. And that's with a 20 pip stop loss. What if we had some technology and we can actually get that stop loss down to 10? Oh lordy, look, we're making $10 a pip. Same trade, same 100 pips. My friend made $125 and we made $1,000 in the very same trade. Now, again, don't overthink this. Don't tax your brain too much. Would you rather have $1,000 return in a trade or $125 return in a trade? Now, see, I told you that the new paradigm is low risk, high yield. And I told you also it works with your mental, emotional, and psychological growth. Here's why. If I'm making $1,000 on that trade and my contemporary, my fellow trader is making $125, do you not see that I could be more selective in my trades? I'm essentially winning 8 times the amount he makes in the trade. I could take less risk. I could take less trades, but take the ones that have higher probability. I don't need to be desperate for trades because they're so profitable. And somebody already said it. What happens when that compounds? Well, that's tonight's lesson. So we're going to look at that. Now, I'm going to throw the disclaimer out one more time, right? So I want to leave trade calc for a second, and I'm going to bring up a pip accumulation compounding calculator. Now, I'm going to have to really blow this up some so we could see it. So let me do that. And hopefully this will come up. Doesn't look too bad there. Now let me blow it up a little. We don't tell you when to buy, Professor. All right, so good. That's kind of visible. Should be visible for most people. You might try going full screen and skipping the chat, because I'm not in the chat box right now typing anything to you. So the only thing you need to see is the screen. So I would recommend you go full screen because you need to see this. We'll come back to the chat box if you want in a few minutes. So here we have something, and you can use this several ways. I want to talk about pips, and what this is. When we talk about pips, we can reference it one of two ways. We can talk about it net pips in a trade, or we can talk about it as net pips in a day. It doesn't matter, as long as you know what you're talking about when you reference this. So what I want to do is a very simple, we know what trade calc does. It does a position sizing. So what we're going to do here is look at just what happens with one trade, and we're going to put a 50 pip stop loss in here just as something to reference. Now, how many pips do you guys want to make in that trade that has a 50 pip stop loss? Somebody give me some numbers. What would be a reasonable amount of pips for a 50 pip stop loss based trade? I want to see what background you're looking at. Okay, I got a 100, I got a 200. I got 200, 200. Does anybody give me 225, 225, 250, 253, 300? What do we have? What do we have? Come on, more participate. 100, 150, 150, 200, 100 to 150. All right, so let's say 150. So we're going to make 150 pips in this trade. Now, I want, just out of curiosity, for those that said, 150, 200, whatever, how many trades like this are you getting per week for 150 pips? How many trades per week for the average trader? If that's a scan trade, how many scan trades a week did you get for 150 pips? Now that's actually pretty good, because that would be 150 complete pips. So you stayed in with all of your lots. The trade probably went up to at least 200 pips and retraced back down. Yeah, 0. But I'm just kind of looking for a number. How many 3 max in a week? 0, less than 1. Okay, bunch of zeros. Okay, maybe 2 to 3. 2 to 3, not many. 1. All right, so I think you see the idea here. We didn't talk if this is a 15-minute trade, a 60-minute trade, or a 4-hour trade. Just throwing out some random numbers here. So we say maybe 2 to 3 a week. Some a little higher, some a little less. It's okay. So I put in the detail here. Now here's how this works. Here's how this calculator works. See, it doesn't worry. We're tracking the number of days in the month that you trade. If we want to call this a pips for the day, then we're going to track this by how many trading days in a month. Essentially, there's 26 trading days in a month. If you include, depending on where you are, us North Americans, U.S., the market opens Sunday. We can maybe get in at some trading Sunday night and trade through Friday. So 6 days times 4 is 24. There's 4.3 weeks to a month, blah, blah, blah. There's typically 26 trading days a month. So you don't want to trade all those Sundays. So you can trade 23 days a month. Or maybe you don't trade at all during the weekends. You just trade 4 weeks at 5 days a week, even though there's 4.3 weeks. So no weekends, day off to go to the beach, day off to go skiing, depending on the season. You know, big recital at your daughter's school, so you go to that. Big soccer game Wednesday night for your son. Your spouse is whining about how much time you're spending on the chart, so you take them out to dinner. So you could trade 20 days a month, 23 days a month, 26. That means for the guy trading 20 days a month, 60 trading days are going to equal 3 months. If he's trading 23 trading days a month, then in 3 months, he has 69 trading days. If he's trading 26 days a month in 3 months, it's 78 trading days. It's still 3 calendar months. But the number of trades obviously goes up if he's trading more per day. All right? So I want everybody clear on what this is about. Now, instead of days, you can say, well, this is a trade. So this would be after 60 trades. This would be after 180 trades. Just depends on whether we want to call this line here a trade or a day. Don't get overwhelmed by this. This isn't tough. So in this particular case, for those that had the 50 pip stop loss with 150 pip gain, look how crazy this gets. In 60 trades, because look, what you said was 150%. 150 pips. So they're earning 6% on a trade, which is crazy. It's doable, but that's also why you said it only happens 1, 2, maybe 3 times a week. If you did this once a week for 4 weeks, that's 25% a month. So let's talk about what's real and what's hypothetical. What's hypothetical is, could I get a 150 pip trade? What's real is, I'm trading with a 50 pip stop loss. What's real is, I'm putting 2% into a trade. What's real is the math, if I get 150 pips, I'm actually making 6%. There's nothing hypothetical about that. Math is not hypothetical. Yeah, see, I don't understand how you're asking questions if you're full screen. And while I appreciate help by putting the link in there now, people have left the session. They're off trying to grab the calculator, all stuff they could have done after the session. And what those people are going to do 15 minutes from now are going to come back and ask a question that was already answered because they've been distracted. That's why we give out the links at the beginning and at the end. We don't want distractive material in the chat. And this is why you should be full screen, because you should be focusing on the actual numbers I'm showing you. So, 60 trades. If I get 1 a week, that's real close to 52 weeks. So maybe a year and a quarter. I could take, if I can do this once a week, and I net this, this is net, I could take my account from $5,000 to $164,000 in just a little over a year if I was doing one a week. Anybody should be able to follow that. So 60 trades, that's one a week for one, times 60 weeks is 60 trades. So for 60 trades, I'll make $164,000. The math don't lie. The only hypothetical here is, can I get a 150 pip trade with that 50 pip stop loss? Can I do it once a week? And for the times I get stopped out, so you kind of answered another question. If I do this once a week and I'm netting that, obviously I'm taking more trades than that because I'm going to lose some. What if I lost on 2 trades? Well, now I'm down 100 pips. So I got to make 100 pips to get back to break even. All right. So you see how crazy compounding is. What this essentially is an interest rate compounder. Now, I want to show you, and I'm asking you, don't go here right now. Stay with me. Let's just talk about something simple, like I gain 25 pips on a 50 pip stop loss. And you will see that you earned how much? 1%. All right, so let's validate this calculator. Now, there are places like here where I round up, where it gives me the results in the green. I don't use decimal places, but let's just look at this 1%. So I'm going to bring up a third-party website right here. And what we're going to enter, and I can't, well, maybe I can. As I say, I can't make that much bigger, but sure I can. What I'm going to enter here is our initial purchase, which is our account balance. Our daily interest rate was 1% because we gained 25 pips on a 50 pip stop loss. And we can say, let's just keep this simple, 20 days, well, leave it at 60. That's fine. 60. It says daily reinvestment rate. So we'll talk about this in a few minutes. Daily reinvestment rate means what? It means you didn't pull anything out of the earnings. You didn't pull anything out of the earnings. Include weekends? No. So that's like our trader who trades, X number of days. Now we calculate it, and we can slide down in this, and I want to go to day 60. And it says $9,083.50. $9,083 and some change. All right. Oh, gee, look at this calculator. If I have 25 pips a day on a 50 pip stop loss, I'm earning 1%. And at the end of 60 days, I've made $9,083. I just want to show you, you can trust this calculator. All right. So we know the calculator's correct. There's nothing hypothetical about the calculator. The calculator is math. We just validated that it's correct. So now the only thing we have to play with are the numbers we're going to enter here. Indeed, if we have a $5,000 account and we have a 50 pip stop loss and we earn 25 pips in it, we are earning 1% per trade, or if that's 25 pips in a day, it's 1% per day. It doesn't matter. It's 60. Whether it's 60 days or 60 trades, that's how you want to use the calculator. Starting with a $5,000 balance in 60 trades, or if one of these a day in 60 days, we will take our $5,000 and it'll be $9,000. At the end of 6 months, it's compounding your gain. It'd be $16,000. At the end of 9 months, it's $29,000. At the end of 12, it's $54,000. At the end of 2 years, it's $500,000. So right now, in 2 years, you can have $600,000 starting with a $5,000 account if you make 25 pips when you have a 50 pip stop loss and you do one per day, 5 days a week, $593,000. Of course, in the online compounder, it said what's your reinvestment rate? It said 100%. That means you pulled zero out of your account. Important note. You pulled zero out of your account. Now, let's look at this same trader. You'll also see real quickly the difference in those 6 days a month that somebody wants to be a little bit lazy. Oh, just kind of tired of the charts this week. I think I'll take the weekend off. Somebody's a little bit lazy and trades 20 days a month. At the end of 2 years, they have 593. If they trade those extra 6 days per month, it's $2.5 million. You want to talk about doing some work, paying it up front, you can do that and totally leverage your account by just a few extra days of trading a month. That's pretty insane. Not here to fluff this all up. First of all, depending on your country, your state, your city, you are responsible for taxes on your earnings. Second of all, are you pulling money from your account to live? We're going to talk about that in just a second. I want to remind you, we're not ignoring this. I'm telling you that it is a responsibility. But let's take the same trade. See, if he could get 25 pips with his 50 pip stop loss and he's in the old paradigm doing traditional things, let's bring him to the new paradigm where everything's going to be the same except one thing. So he's still going to make 25 pips. He's still putting 10% into his stop loss. The only difference is instead of 25 pips, he's come in here with 10. Now, I'm going to write some numbers down. No, I don't have to write them down. You're going to lose yourself here because the numbers are so phenomenal, you're not going to believe it. This is pretty phenomenal as it is. But for those of you who are started to draw pitchforks and started to see you can have a much tighter entry than anything else available in the Forex, except maybe one thing. You've got, with the tools you have on your TradingView charts and the harmonic scanner and pitchforks, you've got all you need to be able to successfully trade 10 pip stop losses. And you know that because most of you are using 3, 4, 5, 6 pip MSLs. So you can actually trade inside of 10 pips. All right. So what you see here now is a side by side. Here is stop loss number 1 at 25. So that's stop loss number 1. Here is stop loss number 2 at 10. And the calculations are over here on the right, kind of hidden for right now, because you're not going to believe them. Yeah, so big that it didn't work. All right, so give me a second to figure out what's going on here. Seeing as how I already looked at this. Oh, I erased the... We're still going to make the same 25 pip gain, my bad. But we're using a 10 pip stop loss. There we go. In the same 60 days, they've taken their $5,000 account to $93,000. At 9 months, they've taken that same account to $32 million. Now this is math. It is hypothetical because there's one other factor involved. Your mental ability to deal with big numbers. So I'm not going to throw, dirt on this great party. But I do want you to see the difference in magnitude. And because compounding takes its craziness, I mean, you're talking, you could settle the U.S. national debt. See, there's somebody saying 25 pips per day. Damn, I'm very sure that's possible. Don't worry about it being per day, per trade. Look, if it took you a year to get to 93, that's not too bad. See, what happens is the compounding goes at an accelerated rate. And here's the thing. Yeah, that's crazy, isn't it? Here's the thing. How many, and I asked you, how many trades earlier on, that you could make 150 pips, etc. on. So let me ask you something. The trades that go 50 pips, or the trades that go 25 pips, what's not hypothetical is if they're available for trader number 1, they're available for trader number 2. If trader number 1 could catch a 25 pip trade, trader number 2 can catch a 25 pip trade. All right, so I want to get one more point in, and then I might circle back and cover a few things. Let me get this last point, because what I've shown you is some math, and I'm not trying to use enticement or anything like that. I'm just showing the magnitude of the difference of trading with the tighter stop and why it's worth your effort. Oh my gosh, if you have to spend 4 or 5 more weeks to get this down pat in the scheme of things, does it really matter? I've had traders that haven't come back. Oh, this is taking too long. See, they're making emotional decisions. They're not making math-based decisions. Nobody's going to achieve these numbers. So, right out here, I'll tell you that. Nobody's going to achieve these numbers. Because you can't keep 100% in, because you're going to have to pay taxes. You can't go 2 years with those kinds of gains. So these numbers won't happen. These numbers won't happen for most everybody. because it's hard to keep all that money in there. But let's just stay with some basic math. And what I want to do is scoot back to just the left side. So I don't want to overemphasize the advantages of trading with tight stops. So let's talk about this for a second. Let's bring this back down to something reasonable. So I'm going to just essentially eliminate the second column for now because I don't want us paying attention to that. It's not, the results aren't going to show anyway. So what I want to do here is bring this down to something pretty powerful. Now watch this. We're going to come in here with our 10 pip stops. That's what we're going to do with our forks. And we're going to gain just 5 net pips per day. See, some people thought 150 pips a week. I might do that once, twice, maybe 3 times. Some people thought that a 25 pip trade a day was possible. What about 5 pips a day? Is 5 pips a day possible? Is 5 pips a day possible? Depends on where you're located. Tax laws are different country to country. If you're in America, in the US, Canada, etc., I would put out a recommendation for a gentleman by the name of Robert Greene. Yeah, but see here, I want to make a point here with 5 pips a day. You don't get greedy because of the results. Just understand you want to start conditioning yourself that I don't have to go trade the pound yen during the London session and make 350 pips for me to make any money this week. The reason I need 350 pips is because I have a big fat stop loss and I lose some trades. So I need that 350 pip trade to make it okay this week. You have to get it out of your mind that that's all old paradigm. I do not need but 5 pips a day. And if I make 5 pips a day and trade not 26, but just 23 days a month, so not every weekend, but once in a while I pop in a trade on a Sunday, a little bit more aggressive than 20 trades. So I can trade 23 days a month. In 2 years, I have $1 million. All right, so you don't need huge trades. You do not need huge trades. You want a tight stop loss, and this is why you look for the pristine pitchfork. Let the iffy ones go by, because here's the deal with this 5 pips. It is net per day. Which means if you're out there with a shotgun and you're going after crappy forks because you're so desperate and those crappy forks don't have enough validation, they're breaching it, they're random, but oh, this looks like a good hit. See, that's your RAS trying to give you what you want versus what's there. And now all of a sudden you lose 3 trades a day. Well, now you got to make up those 30 pips. So don't take crappy trades. Take only the ones that are going to work. You've heard me say, if you've been hanging around long enough, you'll hear me say, my selectivity reduces itself down to this. I only take trades I know I'm going to win. The same kind of trade on the same kind of pitchfork on the same kind of situation that every other time I've taken it, I win. So I rule out the ones that don't look like that because I only need 5 pips. $10 pips in a calculated stop loss. I put my 2% into a 10 pip stop loss. We've got traders who trade 3 pip MSLs, 5 pip MSLs, 7 pip MSLs. The MSL does not change the fact that I've got 10 pips in the stop loss. And if I'm trading something where I need a bigger stop loss, I'm not paying attention to the math. Because what I've done several times now, if you've been in here or you've been watching the recorded sessions, is I've said, for the most part, rule these out. Why? Oh, look at that. 50 pip stop loss, 20 pip stop loss. Let's stay down here with the 10 pip stop losses, with the low stop losses. So I want to focus here, which is why I say focus on the 15-minute chart. You could trade with a 10 pip stop loss for calculating your lots. Most of the time, you're taking yourself at 3 and 4 pips. There's no need to get, see, all of the concept of the big trade is old paradigm. You don't need big trades. You want tiny trades that have much more precision. So we have 2 stop losses in our trade. You need to see the previous sessions and catch up on that. The last 2 sessions covered it in detail. So guess what? I don't go looking for all the big trades. I don't need 4-hour scans. I don't need daily scans. Are you kidding me? No, I don't use trailing stops. We got stuff much better than trailing stops. So right now, just understand 5 pips a day is all you need. We'll talk more about how to protect your money, how to get more trades, but you don't want to get emotional. You don't want to get a pitchfork scan trade and, it goes up and it comes back and you're a little nervous and you take yourself out at 15 pips. You better stand up and do the Charlie Brown dance or the Snoopy dance, whatever you want to call it, because you just did 3 times the daily requirement to make yourself a millionaire in 2 years. This would probably be a good time, if you can achieve this routinely, to walk away from the charts. Because here's what happens. When you win like that, your RAS gets adjusted. And now when you go back to the charts, you have the wrong RAS. $5 pips a day, guys, is all you need. Now, I want to get with one other thing here. Let me come back, Todd, because I don't want to dismiss it entirely. There's times where I'll use a trailing stop, and there are exceptions, though. It's not my go-to thing. I use a trailing stop when I'm good in profit in a trade. I'm 50 pips up on a trade, and I'm not going to be able to be responsive. Meaning, I'm going to the mountains to go gold prospecting, and I have no service. Otherwise, I have other things that will alert me to move my stop and to exit the trade that will give me a higher percentage of the gain. But let me ask a question. I think I might have done this with this group. I do this with my traders all the time. If I'm normally used to making $1,000 a day and something comes along, like I'm going to go up to the mountains for the day where I have no service, and I'm in a trade that could make me $1,000, but I switch my money management to something that's automatic, like a trailing stop, because I'm not going to be able to get service, and maybe that trailing stop erodes too much profit or more profit than what I'm normally used to, and I can only get 500 on that trade. Let me tell you what I'm going to do. I'm going to use the trailing stop and get my 500. Or I cannot take the trade and get zero because I'm hell-bent on getting $1,000 in the day. So there are times, but trailing stops are not the most effective way to deal with the trade. Trailing stops typically are used in bigger, longer-term trades. They can be used everywhere, but people like them in bigger, longer-term trades. And we just have stuff. We have more stuff for precision entry. We also have stuff for precision exit. I saw somebody post a fork this morning, and it was like this. Boop. Well, white ain't going to work on white, will it? Like this. Doot. 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 And they entered a trade, down here off of a bounce, and it went like that. And so they got 100% of that, well, like 99.9. 2 pip pullback here, 2 pip pullback here. They got 99% of the move. They didn't need a trailing stop. They protected their profit along the way. But the bottom line is there was a hard target that was, if it bounced there, that was the exit. I don't let this come back and take me out on a trailing stop when the pitchfork opposite wall is there. So there's some things unique about pitchfork trading, not just on the entry side, but on the exit side as well. All right, I want to wind this down because I don't want to get in the habit of going 2 hours. That's not fair to those that scheduled an hour. So let me show you something very powerful. And now I'm giving you a little secret about the gurus, and I'm not speaking of our educators. I'm speaking of just traders in various places. Some of them are IML members. They just haven't learned enough yet. But you want to be careful sometimes who you listen to. So I want to show you something here. Again, pay attention to the first column. 5 pips a day. 10 pips stop loss. You see the results. Now what I want to do here is I'm going to mimic the numbers over here. A 5 pip gain with a 10 pip stop loss. And then I want to scroll to the right so you can see they are indeed the same numbers. And I'm doing this just to be a number holder. So when I scroll right now, well, that's 1-0. That's not going to work. Oh, my lordy. I don't get it right yet. Trust me. All right. So when I say a number holder, what I want you to see is the numbers are exactly the same. 9083, 9083, 593, 239, 955,000, 995,270, 995, 270. 2,486,035. All right. Now this is going to be the biggest thing because you saw the massive compounding that takes place when you reinvest your money. It's insane. But there's another aspect. If the trade was set up, I rarely re-enter a trade on the opposite side. Why? First of all, my RAS is now shifted because I've got adrenaline flowing through my body. Snoopy dance, Snoopy dance. Second thing is, I'm looking in the opposite direction. As price was moving up, I was paying attention to my support and resistance. I was paying attention to Fibonacci's, etc. Going the other way, I got to redraw it. My RAS literally floats upside down. And it's not wise to do that. The second thing is, come on. They just went the entire width of that pitchfork. I don't remember whether it was 80 pips or 120 pips. You need 5 pips a day. Why be greedy? You're going to have to learn, guys, patience and no greed. This is why I'm spending this time with you tonight, so you understand you don't have to be greedy. Look, nobody else is going to do it this way. Everybody else is running like a sheeple to the London session, trading the pound yen to get the big pips. And with 5 pips a day, I could have $2.5 million in 2 years. Why do I need to go trade big trades? Why do I need to take trade after trade after trade? Get a life. Have some fun. Study more. Do more self-development. I'm not saying get in a trade that could go 100 pips and exit at 5. That's not what I'm saying. What I'm saying is, if you make 45 pips, if you make 17 pips, don't get desperate to try and make more. Not with the new paradigm, not with the stop loss strategy. You're well on your way to busting these numbers. I mean, I don't know if there's any studies out there, but how many people do you think in Vegas would turn the tables if after they got more than they came in with, they walked out of the casino? They come in with $200, they're at $500, and instead of leaving the casino, what do? Oh, roulette wheel, man, I'm lucky. 500 down, double or nothing. All right, so we've got our side by side. Now watch this. And this is my punctuation mark on the night. The way this calculator works, and I'm going to go all the way down, show you what happens. I can't fit it in as big as I have it. So essentially, on day 1, I made 5 pips, which is 1%. 1% of our $5,000 balance is $50. I add it to my balance. And that goes all the way then across the calculator to leave me a new balance of $5,050. I then earn 5 pips, which is 1%. But that 1% now against 5,500 or 5,050 comes out to $50.50. 50 cents more than the previous time. My balance is now 5,101, and we go across, keep marching down. So every time I earn 5 pips, it's still 1%, but it's 1% of my balance. So the earnings grow because they're a reflection of my balance. This is called fixed percentage risk trading. And those numbers just keep growing per trade. Down here, I'm earning, on trade day 131, 5 pips a day. One 5-pip trade makes me $182. Up front, it made me $50. So that's the power of compounding. All right, now this is going to scare you when I show you this. And you're actually going to think back to Facebook and some posts that you've seen, and you are going to first of all go, oh my God, and then you're going to do a little laughing at some of these people. And what I want you to see here, and we'll come back to Tim in a second as we wind this down, and some work that Tim did for us for tonight. So let's stay with our 5 pips per day. 10 pip stop loss. Nothing's changing there. Just make it the same. So the second column is our number holder. So here we go. We started with a $5,000 account. Now watch this. I'm going to zoom over to the right-hand part of the screen so you can see the daily balance grow. We started with 5,000. We're making 5 pips a day. And we've convinced, I've convinced my girlfriend that she should be supportive. So, when I come home from work and we chit chat and we have our dinner and I say, okay, I got to go to the man cave and trade for a couple hours. And the first couple weeks she moaned and groaned and she didn't like that because she's what you call a Forex mistress. She's second fiddle to your Forex mistress. And she doesn't like the attention your charts get compared to what she gets. But the ones that don't have wicks, we've talked about this. So we don't trade. It's not so much that the pound yen isn't something you want to trade. It's the pound yen isn't something you want to trade when at the lower level charts it's still very wicky. So here I am. I got my girlfriend. She's being good. Oh my gosh, is she being good? And she's been very supportive. But at some point, as I'm moving down here, can I show both at once? No. Yeah, I'm going to reduce this by 5% because I'd really like to squeeze this in. Let me bring this down just 5%. Yeah. So she's been so good. And what ends up happening is about the time I make, I'm into this deal and I hit $25,000 in my balance. Day 162. She comes up to me and she goes, babe, I've been supporting you 6 months. I've been so lonely. I think we need to take a trip. And I've been looking at the internet, and my friend, Sally Sue, she's in one of those travel MLMs, and she said she could get me a deal. And I looked it up, and for a week-long trip, we could go to Bart's, St. Bart's, and with the airfare and the lodging and all the meals included and gratuities and jet skis and everything else, we could do this trip for just $3,500. So I went from 5,000 to 25,000, and now Sally Sue's the travel agent. I want to take her to the St. Bart's. I got to take my girlfriend. So now Betty Boop has convinced me, because she's been so supportive and she's helped me been so successful, that we need to go to St. Bart's for a week, and it's only going to cost us $3,500. And as you can see, it subtracted the $3,500 for the balance. It's not subtracting $3,500 every trade. This is a year-to-date removal total. So it remains $3,500 unless I move something else out. So we took out $3,500. And we go to St. Bart's and we come back. And it's, oh wow, it's so good. But let's look at something. Remember the placeholder. At the end of a year, that $3,500 cost me essentially $8,000. At the end of 2 years, if I'm trading just 20 days a month, at the end of 2 years, that $3,500 cost me $83,000. If I was trading 26 days a month, at the end of 2 years, that $3,500, 100, 200, 300, 200, 300, 400, and let's call it 50, just short of it, cost me $350,000. See, compounding works when you remove money as well. And so we go on our trip, and I'm just, Joe Blow trader. I don't do the math. And so what ends up happening then is we go a little further, and she decides about the time I get, I'll pick a number, not too much farther along. We had such a good time, maybe 3 months later, she kind of puts the whammy on you and says, now's the time. And you say, okay. And she tells you, you need to put a ring on it. And you go out and get the cheapest ring. You go out and get a cheap ring. I don't know. Pick a number. $6,000. No, let's do this. Let's make it fun. $6,500. I'm thinking ahead in my math here. Because what you can see then is between the first $3,500 and the $6,500 for the ring, I've pulled out how much? $10,000. So let's go look at our normal and our placeholder. What does that do? Oh, look at that. We've taken $10,000, one with $3,500 for our trip, the second one for $6,500 for a total of $10,000. And at the end of 2 years, trading 20 days a year, it cost me $200,000. You think those banks with 24% interest rate credit cards are scarfing money? $10,000 cost you $200,000. So now here's the funny thing. Now you guys understand math in both directions. In the positive compounding, what happens? Yeah, oh, that's a cheap ring. For positive compounding, you see how it skyrockets. When you pull money out of those earnings, especially in, the first year, it really costs you. So now here's the joke. Because I know if you've been around a while, if you've been in IML a while, you've seen the posts. Yo, bro, here's my $10,000 withdrawal slip. Oh man, we're going to eat for a week. And in fact, you have some who want to challenge each other and say, you're not a real trader unless you can show me withdrawal slips. And you know what I do? I laugh. Because that's not a real trader. They don't understand math at all. They're pulling money out that they don't need to pull out just to show people they can pull it out. It's crazy. And then I've seen even bigger ones. if you want to compete with me, you're going to have to show me $100,000 withdrawal slips. I'll be glad to show you mine. Woo! You boys need to do some math. You need to go back and find that Math 8 teacher that just give you the grade even though you didn't know what you were doing. So next time you see somebody post something about a withdrawal, or you ain't legit unless you show me a $10,000 withdrawal slip, just laugh. Because I can tell you, first of all, he's not accelerating like we're accelerating, and that $10,000 is really gonna hurt him. Is really gonna hurt him. And once you realize $10,000 means 200, look out. Now, let me show you something else. Let's go back down, and we'll wind it down here. No, we won't. Got one more thing to show you. Let me go back here to days. Oh yeah, we're up here. There's the ring. I'm going to take it out. And we're going to come up here and take this out. Now, y'all are traders, and that's okay. And I know a lot of traders, are here just to learn how to trade. And there's nothing wrong with that. That's why I'm here, to teach you how to trade. There are people who brought you here who are IBOs. Oh, you would never leave $10 million in a trading account. I would never leave $10 million in a trading account. First of all, I'm not going to drop any numbers, and I'm not going to tell you when and what, because I'm not an investment advisor, but I will just tell you that when you get to certain numbers, now I'm speaking North American, okay? I'm speaking North American. If we're trading overseas, that money's not necessarily protected. Not like it would be somewhat protected in the States. It's not protected in the States either. They're just guidelines for the brokers, but that money is not insured. So you would never want that much money with an overseas broker. And there's other reasons, but eventually, if you're North American, when you get a certain level, you're going to move your money to a regular bank, and you'll establish a banking relationship with Citi, with BOA, etc. First of all, as a North American, they do not have FIFO restrictions. They do not have no hedging restrictions because they're not subject to the CFTC. I can't tell you numbers because I'm not an investment advisor. Trust me, when you start getting enough, we'll have a phone call. Somebody will be able to help you. So we took the ring out and we took the other thing out. Now let's look at this in the opposite direction. What if at day 31 you are a Platinum 5000 as an IBO? Platinum 5000 makes a minimum $5,000 a month. You take 1,000 of that at the end of the month and you put it in your trading account. I think the way I have this set up, I have to put a negative in front of it. Yep, it adds it. And at the end of month 2, you got your Platinum 5000. Well, you get it each week, but maybe you put in that last payment. You put in another $1,000. Whoops. Man, this thing just likes to grab stuff from other places. I don't know how it's doing that. Oh, man. Everything going wrong on me. Promise we'll be out of here in just a minute. So, minus 1,000. And at the end of the third month, you put in $1,000 from your $5,000 check from IML. And at the end of your fourth month, I'm just going to do this one more time. Bear with me. and at the end of your 5th month. Plus or minus a day, doesn't matter. So now you can see the running total is $5,000 for the year you've inserted into your account after 5 months. I put $5,000 in my bank in 5 months. At the end of 2 years, let's jump down at the bottom. $5,000 is equal to $1 million more in my bank account. Is that insane or what? That's crazy. $5,000, and in 2 years, because of the accelerated compounding, not just the compounding, but you're accelerating the compounding, you raised it $1 million. $5,000 payment. Is it worth saving? Is it worth scrimping? Here's the bottom line on all this. There's with the new paradigm, you do have an accelerated compounding growth. If in that new paradigm you take money out, it still grows. You saw the account grows. It just, oh man, my mouse. It just grows a little slower. It's still darn better than being in the old paradigm. It's just, do you really want to give up that delta for a week in St. Bart's and to put a ring on it? Lastly, if you add to your account ever so slightly, you get super accelerated growth. So those are your options. You leave it, you take some, or you have something going on the other side to add to it. Now, Tim spent some good hours on this, so first of all, I want to, acknowledge his effort and his work, and we should all appreciate what he did here. And I'm going to end with this. So Tim went to the web scanner, and he looked at 15-minute, 60-minute, and 240 scans, just with what was on there today. We'll do this more as we go march forward in the future, but just for today. So there's nothing hypothetical here. There were 17 15-minute scans. The average stop in those was 28.49. The CD leg was 100 pips. So what do we mean by that? We've got our scan. X to A to B to C to D. And it paints out. So that CD leg then, for that bearish trade, gets divided up with, there's your 38.2, there's your 61.8, and there's your 100%. So if this scan went full length, it's essentially retracing the CD leg. And what we found was, with your 15-minute scans, out of 17 of them, 100 pip was your average C to D, so it would be your D side trade. For 60-minute trades, there were 12 of them that he looked at, picked off the numbers, crunched them in a spreadsheet, came up with the averages. The average stop on a 60-minute trade is 55.75. The CD leg 167.41. Same thing on the 240, only 3 240 trades. Now, in these limited numbers, he got about 90 pips for your average stop. I did the same study, back in March or whatever. I looked at 13 scans, and of those 13, the average stop on a 4-hour trade, on a 4-hour scan, was 148.2. So it's somewhere around there. Pretty big variance, but you can see it's still pretty big. So let's just take something simple like your 15-minute scan. And let's say you pick a number, 50% of it before you get stopped out. Now, if the scan has a potential to go 100.57 pips, it's going to have the same for you and me. And it's going to have the same for our old paradigm trader and our new paradigm trader. Our money management inside the trade doesn't have to differ. Whatever they're using, 38, 61, 100, we're using the same money management. We're going to get the same 50 pips when all's said and done. The difference is 28.49. So let's use real numbers instead of hypothetical numbers in our scanner, in our calculator. 28.49. Let's call it, I'll round down, 28. I'll give them a few bonuses here. So we're going to make 50 pips. We have a 28 pip stop loss. We're going to make 50 pips. And we have a 10 pip stop loss. Now again, number of trades is all we're worried about. Let's pick 10 trades since I don't have that on here. Just 10 trades. Now remember, accounts grow. So in the first column, which is 82 here, they've grown their account with 10 such trades in the old paradigm with everything compounding. They grew their account to $7,102. You're using pitchforks, and instead of 28, you get to get in there with 10 pip stop losses, which means you have more lots on the trade, which means you're going to make more return. So for the first 10 trades, when they make $7,102, your total is $12,969. It's $5,000 more. I know that doesn't seem like a lot. $5,000 is the size of the account that you started with. Let's look at 50 trades. So each of you get one of these a week for the year. Just 50 trades. They've taken their account to a respectable $30,000. Pretty respectable $5,000 start. It's a 517% growth. If you were a hedge fund driver and you got 517, you'd be top 2, 3 in the country, in the world. So they took their account to $30,000, $30,800. Let's call it 31. $586,000 after 50 trades. Versus 38,000. And somebody says it takes too long to learn pitchforks. Now on the high side, it's not going to happen. It's not going to happen. I'm not saying it can't. I'm just saying it probably won't. Okay? It probably won't. Oh, wait, it gets even better. I forgot about that. On the trader's account that went to 38, we had 2 or 3. He put extra money into his account on top of it. We didn't in ours. So On the high side, I don't think anybody's going to achieve it. But what I wanted to show is using the actual scans and the data from the scans that are typical data. Now, look, you can say that's a 50 pip gain. You can call it, oh, I got a 100 pip gain. You can say, oh, it only went 25 pips. Just remember, it did the same for Trader 1 and Trader 2. You can't change up, oh, well, he got 25 and you only got 10. It doesn't work that way. If you're going to work with a hypothetical number, it's the same hypothetical number for both traders. So there's no hypothetical in that. That's real. We're using real data, real numbers, and, the gain you can pick. I don't care. You want to say you got 10 pips? You want to say you got 20 pips? You want to say you got 50 pips? You want to say you got the full run, 100 pips? I don't care. As long as you give them both the same pips. You're going to see these same relationships over and over and over again. So Tim, a very special thank you to make this session here at the end very real. Where did that go? I did have a thank you. Oh, there it is. Special thanks to Tim for gathering all the data. It took several hours to do that. So, guys, the truth is out there. It's in the math. It's in the math. And here's the deal. Here's your secret to the Holy Grail of trading. And that is your scan is what? It is your pitchfork alert. It is your pitchfork alert. Everybody's out trying to catch the D. Hey, if you catch the D, I'm happy for you. I'm not saying you shouldn't. What I'm saying is we have a special use of this scan that when everybody else has walked away from it, we're going to get more trades. We can talk about, oh, we both got 50 pips, we both got 100 pips in this trade. Nice. Well, it just so happens we made another 100 pips. It just so happens we made another, 50, 60 pips. We made the same 100 you did, and we smoked you, made 2.8 to 1 times the profit you made, and then that gets compounded trade after trade after trade. And then we got another 100 pips, and we got another 60 pips. Thank you, Scan. Thank you, Christopher Terry. This is a brilliant piece of... Guys, you've got something very special here with the scanner. If you avoid the Charlie Deltas and the X-ray Alphas, you're missing out. You just don't get the math. The math can drive your trading. It should drive your trading. And I'd love to see the disbelief on old paradigm traders when Charlie Delta trading with just 5 pips a day is creating millionaires inside IML. And the old paradigm is thinking, what? What? How'd you do that? Oh, just 5 pips. What? Yeah, just 5 pips a day. So, pretty powerful. All right, now, here's the deal. Right now, I'm not going to give this out. And I have some liability issues. First of all, it's not clean yet. I don't have it locked down. But I showed you earlier, and I told you not to pay attention then, but I'll let you pay attention now. You can go to, right up here, Compound Daily. Now, this is an interest compounder, which is essentially what my calculator is too. So the only thing you really need to know here, other than what we were doing, is what are you compounding on a daily basis. Just remember, if I put 2% into a trade, I put 2% into my 28 pip stop loss. If I make 14 pips, that's 1%. So you're going to have to figure out here, to use this calculator, what percentage to enter here as a return. If I put 2% into a 28 pip stop loss, and I get 28 pips, boom, I'm done. Simple fractional work here, guys. If 2% gave me 28 pips, what do I do if I made 17 pips? Remember how to cross multiply? That's all you're doing is solving for x. And x will be the percent you enter here. Length of term, that would be how many days. That could be trades here too. It could be number of trades. Reinvestment rate. Are you reinvesting 100%? Are you taking out 20% of your earnings? You have a chance right here. Include weekends, yes or no? I'd say no. Just make it 5 days a week if you're going to do something daily. And this will give you the exact same numbers, which is where I started with to validate the calculator I was showing you. These two match up exactly. You just have to calculate what your daily return is. Here it's saying interest rate. The reality is this is your daily or per trade return on account. Same calculations. So compounddaily.com. Yeah, there's also something on the IML Elite. The reason I like a full-blown calculator is to be able to look at things like pulling money out, is to be able to do side-by-sides, is to be able to look at putting money in. So there you go. You can go to daily compound daily, and you don't need to go at all. I've shown it to you tonight. You can trust it. All you need is 5 pips a day. This is why you get good with your pitchforks. This is why you learn to discern good from bad. High probability versus iffy. See, iffy means go spend your money at Vegas and have some fun. So that's it. Any questions before we end the session? 2 hours anyway. Dang. Five pips a day, 10 pips stop loss. You're set as a trader. I'll say this. It's how much you play Cortez. Everybody know Cortez? Burn the boats. The more you burn the boats and commit, the better off you are. I don't care, if Jason's talking to you about that as an IBO, or if I'm talking to you about that as a trader. Commit. It's worth it. Go 2 years and you're set for life. Go 2 years and you're set for life. Oh, trust me, I've been coaching, almost 14 years now, 13 plus, and I've got traders that come back to me about every 3 years. They leave and they come back and they leave and they come back because we went too fast. I went too fast for them, too slow for them. They wanted to go faster, so they went elsewhere. And what did they get elsewhere? Oh, they found their 2-step system, their 5-step system, their PDF file, that one page they could download and trade. But guess what? No money in that stuff. All right. Well, I don't see any questions, so we're good. It is Wednesday, last session of the week. Vegas still on everybody's mind here, and more and more stories. There's a guy and his wife about 5 blocks down from me who were there and got out. They were in the very center of that concert, and they got out with unscathed. Big newspaper article on them the other day. But that was just senseless, ruthless craziness. And just, oh my God, just think about innocent people. But anyway, it's a good example of life can be short. So for those people you care and love, let them know you care and love them. See you guys in Facebook land. Have a great weekend. Monday night. Monday night.